Here we are. I hope the others are not confused that we're meeting in teams. It was just intended to have a session if you had questions and you wanted to speak instead of text me in the chat. But no one who entered had questions, but it was not a large group either. So if you do want to speak with me, we can arrange that and talk through Teams. Or, WhatsApp. Some students have contacted me through WhatsApp for some help as well. So where I want to start today is with this document 33. It has the wrong course number on it, but it's document 33. I'll just check my connection because for me it looks a little bit blurry. Anyway, so do you have any questions about the material to this point? So what we did was we learned about the basic time value of money. I taught you formulas that you could use for future cash flow. So we learned about valuation, time value of money. Then we talked about different applications of time value of money, mortgages, loans, annuities, pricing stocks and bonds. Then we learned about NPV and other measures that help you choose between alternative investments. So we learned about NPV, IRR, and payback period, discounted payback period rules. Then we learned about returns, and we learned about risk and how to measure those. And then I taught you how you can relate them one from the other, and you can trace. And the goal was always to find the proper, appropriate the cost of capital or the required rate of return. And in between here, we did something known as capital budgeting. Before we went into this, we did capital budgeting. So we've done a lot. I know you've covered a lot. Now you're a mixed group. Some people have some previous knowledge and some people do not. So I hope by watching the videos they can help you understand, or that Taylor's doing a fantastic job in helping you keep up and follow along. What we're going to do next is talk about capital structure. Capital structure is the combination of debt and equity used to finance the firm. From the balance sheet of the firm, the market value of debt, known as and the symbol B is used for that, and the market value of all outstanding equity or outstanding stock is denoted by S. What the firm owes is what it is considered its assets or what it owns, all right? So in this way, our financing in our firm is equivalent to the value of the firm. And we visualize a pie structure, and we have debt and equity to make up the value of the firm. The question is, does the ratio of debt to equity, does the relative amounts of debt and equity determine the size of the pie? Can we increase the size of the pie by choosing the right amount of debt and the right amount of equity? There are two questions we're going to focus on. It's not clear, I don't know why. I'm not sure what's happening with the feed. It's blurry. Refresh your page if that helps. I don't know, it still looks blurry to me too. Let me see. My connection. My connection is good. It says excellent. I don't know why it's blurry. Is that better, Jeff-san? How is the sound? It might be blurry now, but then when you watch it, it will be clear. It happens that way sometimes. It looks a little bit blurry, but then once it records, it'll be clear. Okay, so there are two questions then that we're going to focus on. Since the shareholders are the owners of the firm as a group, the firm should conduct itself according to the will of the shareholders. So should the shareholders care about maximizing their shareholder wealth, or should they care about maximizing the value of the firm? If so, is there a trade-off between shareholder equity and debt holders that would actually accomplish that, increasing the value of the firm? Those are the two questions. Should the management aim at maximizing the value of the firm or just S? Well, it should do what the shareholders want them to do, right? That's what management should do. So we need to figure out what the shareholders want. Do they want the value of the firm to be the priority? Just checking my quality. I don't think I can change anything right now. But I didn't change anything from previous videos. I didn't. Same settings. I don't have it. I never used different pixels. Anyway, it looks fine. It looks fine to me on my recorded feed. It just doesn't look nice on the live feed. It's very strange. It's crystal clear on the recorded feed. So Monsieur Sever, do you see it fine, or are you having problems too? Refresh your page. The feed is perfect, excellent everywhere I look. Okay, you have to change the quality. Okay, thank you, Monsieur Sever. So yeah, you change your quality on your end. Okay, so as I was saying, should management aim to maximize V or S? It depends on what the shareholders want. And second, if that's the case, if they care about V just as much as S, then what is the best debt to equity ratio that will maximize shareholder equity? Okay, so do shareholders want debt? Will that increase V? Is the question. So I am going to begin with an example for your consideration. I've put some numbers here. You could change the numbers, but I've covered, it's a comprehensive approach where I look at the best state of the world, the status quo, and the worst conditions. So imagine you begin with a firm that has no debt. Okay, so this firm, this corporation, only is owned by shareholders. The shareholders finance the firm. So U stands for unlevered. Unlevered means no debt. So B for debt, S for stock. Okay, so you'll see, Monsieur Sever, how debt plays into the picture, okay? So here we have this firm. The value of the firm is $1,000. There is no debt. Since there are only shareholders, shareholder value, the shareholder equity is also $1,000. And imagine there's 100 shares. So I've given you this amount of shares information. And then that means each stock has a price of, each share has a price of $10. All right, so what I'm going to do now is imagine a debt issue. Let's say B is increased to $500, and this is then a result of selling bonds to borrow $500. Okay, so bonds have been sold. Effectively, $500 has been borrowed. And then the $500 to appease the shareholders has been distributed as $5 dividend to them. So I don't know the effects of this action, but I can imagine the best, status quo, and worst case scenarios. In any case, the B has gone up to $500. Leaving, so the L here stands for levered. So now we're talking about the levered firm. That's with debt. If I want to compute what the shareholder value is now that debt holders have been taken on, you have to look at the value of the levered firm minus the debt would be the shareholder equity. So imagine it is perceived as a good thing. Let's say the value of the firm goes up to $1,250 because shareholder equity, although it goes down from 1,000, debt issue is 500, so these sum to make 1,250. So this doesn't go down a lot, all right? So the value of stock goes down the market value goes down. But now we have outstanding debt. So these together create the value of the firm of $1,250. So that's the best case scenario, that the value actually goes up from 1,000 to 1,250. So you see that debt can increase the value of the firm as long as it doesn't adversely affect shareholder equity. What if nothing changes? For nothing to change, then shareholder equity should be $500, and there's the debt still at $500, and the value of the firm remains the same, $1,000. In the worst case scenario, the perception from the market is that the value of equity has dropped. So in that perspective, actually the value of the firm goes down from 1,000 to 750. So these are the three scenarios, and you could change the numbers. The point is, this is an example of the best case scenario where the value of the firm increases by issuing debt. It could be that it stays the same, or it could go down. Whatever the case, looking at this chart, whatever happens to the value as a result of taking on debt directly affects the shareholder. Have a look at this. If I look at the payoffs to shareholder, don't forget that they have been compensated the $5 dividend from the debt issue. So this $500 was borrowed and redistributed to shareholders, taking on bondholders, still having shareholders, and the share value did go down, so the capital gains was negative. You see, this is in the the best case scenario, and it only went down to 50, from 1,000 to 750. In the no change scenario, it went down 500 from 1,000, so this is negative 500. And in the worst case scenario, it went to 250 from 1,000, so that's a capital loss of 750. Put that together with the cash. So remember, how do we look at dollar returns, right? Capital gains and dividends. So the dollar returns are the payoff to shareholders after the restructuring align with what happens to the value of the firm. The value of the firm went up, there's a positive payoff to shareholders. The value of the firm stayed the same, there's no change to the payoff of shareholders. And in the worst case scenario, the value of the firm drops, and so there's a negative payoff to shareholders. So this is an example demonstrating that when the value of the firm is high, so is the value of shareholders. When the value of the firm is low, the value of the shareholders drops. So shareholders should be concerned with the firm's value. So they do care, and they can use, it looks like they can use debt to increase their payoffs, profits, revenues. I don't know, you can call it payoff, because we're putting together their dollar return in capital gains and dividends. Any questions about this example? So all I've done is considered a very simple example with the whatever happens by the debt issue, shareholders care. They care about the impact on the value of the firm because that impacts them directly. Or I say indirectly, I guess. So if you want to fix your settings to view things better, on this screen, you need to tap beside the captions, there's the settings key, the settings, I don't, what do you call that in French? And then you can see the page clearer. Okay, so just under the video, you can see beside CC, there's a tool, and you can see things much clearer, as described by Monsieur Sever. Okay, questions about this? Okay, so capital gains, good question, would be the difference here, because this is equal to the 1,000, right? And now it's, sorry, let me do that again. We have to take the new one, which is the value of 750, minus the original of 1,000. That's how you found 250. And here it's now 500, but originally it was worth 1,000. So that's how you get negative 500. And I'm getting this because the original, so capital gains, right, is price, dollar returns. And so we're looking at the value now versus before. The value now is 750, and before it was 1,000. Is that okay? And then here, this would be from 250, which is here, minus 1,000. So I'm taking these values here for the value of the new value of the firm. Very good. All right, so you follow. Okay, so the conclusion is that the shareholders do care about V, and they do want to consider how debt can be used to increase the value of the firm. Okay, so here it was used, the firm issued debt and then distributed to pay off shareholders to take on debt. So from the firm perspective, this can reduce the risk or the cost of capital, and I'll show you how, okay? We will be talking about that as well. So any questions about this? No? Okay. So you talk to, okay, if you cannot go to Port-au-Prince, then it will have to be online. But then we can set it with the time as well. I can set it up with the time. It should not be very difficult. It's going to be multiple choice, and I'll put it, I'm trying to think if I can put it in any platform for you. Probably not. I wonder if we can use the platform that I use for the statistics, because most of you should all be in there. Okay, so I will communicate with Doran, okay? And let you know, you'll be informed if it's going to be a test I send by email or if it's one online that you can solve. So I'll talk to Doran. I will speak to Doran about whether it will be a test that you solve online. Okay. Okay, next. So there is theory that has been developed around the second question. Is there an optimal capital structure? The theory is known as M&M for the creators Modigliani and Miller. And they developed this theory with a series of models, beginning with a very, very simple model to show you when it doesn't matter. Okay, so they've created an abstraction of reality to show you when it does not matter and that the value of the levered firm and the unlevered firm are identical. For them to be the same, for the value to be the same, these are the minimum requirements, okay? First of all, we are going to assume that debt has no risk. Okay, so adding debt or taking on issuing debt and having bondholders, there is no risk from the firm perspective that they can pay interest payments to bondholders. Okay, now that's really an important assumption. There's no additional cost or consideration of the amount of debt that they can have. So it's unlimited, really, with no risk of default. It could be, if default was a concern. The next assumption is that cash flows are perpetual. It means that when I show you the net income of the firm, or the cash flows, net operating cash flows of the firm, those are assumed to be the same indefinitely, so forever, right? And we also have this strong assumption that firms and investors can borrow and lend at the same rate, which is not the case because firms will have preferential rates to the rates of investors. So that's not necessarily the case in reality. None of these are the case in reality, but these are the abstractions we need to obtain this result. And in bold here, I have the most important of the assumptions is that there are no taxes. So how does this affect things? Well, a benefit of issuing debt from the firm perspective is that interest payments made to bondholders is a tax-deductible expense. As a result, it reduces the taxable income of the firm and at the same time, as a result, accrues tax savings. So there's a tax savings effect that we've removed by saying there's no taxes, okay? So there's no advantage of having debt purely because of the tax deductibility of the interest payments. So those are the assumptions. There are others, but these are the most important in the model. And as a result, there's no difference. Debt has no effect on the value of the firm. Okay? So this is known as M&M Proposition 1 with no taxes. Very abstract, not reality, but you end up with the baseline case. So here's an example to demonstrate how that's possible or what's happening. Imagine you have a firm with no debt. So assets are $1 million, which is just the shareholder equity, no debt. And compare that to a levered firm. We want to find out what's the value of the firm with debt if we issue $400,000 of debt. What happens to shareholder equity and the value of the firm as a consequence, where the cost of debt or the yield to maturity is 5%. So these are bonds. This is a total of all the bonds, $400,000 worth. Keep in mind the assumptions that firms and investors can borrow and lend at the same rate and there are no taxes. And because of perpetual cash flows, we assume that no matter which firm, this is a strong assumption, their assets are given by Y. So essentially what I've done, or what they did, is they made them equally productive, okay? This is the dollar return on operations, dollar return. So they're equally productive. In any given year then, we can look at comparing a prospective investment in either the levered firm or the unlevered firm. This is document 33 that I sent to you. If you want to follow along in your notes, if you want to print the page. Let me give you a moment to read through it, okay? And then we'll discuss it. There's no sound because I'm waiting for you to review the document. Okay, so let's see. Yes, it's a very, very, it's a very strong assumption. But like I say, this is just to prove the baseline case. This is just a model that was developed to show you when they would equal. So basically, because these assumptions will never be met, they should never equal, right? That's basically what we're saying. These won't equal because at least one of these will be violated. I mean, maybe there's no taxes, but no risk of default. It's a strong assumption. It could be if it's a really reliable firm with a reputation. Could be. But then all these assumptions need to be in tow, and they're very unrealistic. Okay, so the point is that this is not realistic, but this is when they will be equal. And the exercise we're going to carry out now is to demonstrate how that could be the case. I think they can hear me online. All right, so we begin with an investor, a prospective investor in, very good, Elaine, a prospective investor in the levered firm, so the firm with debt. So the investor in the firm that has issued debt chooses to buy 10% of the outstanding stock. That's what this means. Then their dollar investment would be equivalent to 10% of SL, or that's the same as, right, 10% of V minus B. Always remember that V is equal to S plus B. So the dollar return would be 10% of, remember Y, that's the dollar return for the firm, but this investor would get the residual, right? Because he's a residual claimant, he's a shareholder. So first the firm pays the bondholders interest payments, and that's this amount. See, this is the rate of interest, and this is the outstanding debt. So this gets paid, and then out of that difference, the shareholders get paid. So we'll imagine that all profits are shared with the shareholders. So he gets 10%. That's not necessarily the case because a firm could reinvest any returns. But in this case, they're going to redistribute to the shareholders, and this person is entitled to 10% of outstanding stock. So here are some of the numbers. I told you that the yield to maturity was 5% on the debt, and that $400,000 was issued. So we can figure out mathematically, this is the dollar return. So the dollar return is 10% of the dollar return to the firm less the payment to the bondholders. So these are the results of an investment in the levered firm. For the unlevered firm, So this is a firm, this is an investor investing in the firm with no debt. So that investor buys 10% of the outstanding stock in the unlevered firm, right? So remembering that this is the same as, because there's no debt, the value of the firm is equal to shareholder equity. But I'm going to write everything in terms of V's so that it reinforces my hypothesis that the values don't differ. Okay, so this investor is invested in the unlevered firm in the same amount, 10%. And so that would be the dollar investment, and then this would be the dollar return. Because there's no debt, they're entitled to 10% of the dollar returns to the firm. Now, on their own account, investors in the unlevered firm can borrow just like the firm did at the same rate. That's what we said. Not from the levered firm, but just an equivalent amount in the open markets, because that's what it says here, right? Firms and investors can borrow and lend at the same rate. So this investor borrows the same amount that it would be BL, 400,000, right? It's better to write 400. So they borrow 400,000. Not all 400,000, but 10% of 400,000. So that's 10,000. But I'll keep it in symbols. So this is the symbol. It's going to be borrowing 0.1 BL because this is going to be paid back. So the dollar investment is the purchase of the stock, 10% of the stock in the unlevered firm, and less the borrowed amount, because this has to be paid back. And then what is the dollar return in this for this investment strategy? So they borrow on their own account. And reproduce effectively the same dollar return as though they invested in the levered firm. So what I've demonstrated is they can achieve the same dollar return by investing in the unlevered firm and borrowing on their own account as they would have if they invested in the levered firm. So these are the same. So this is the dollar return. They get 10% of that by being shareholders. And then they will have to pay back, right, the debt at 10% of this interest. So they have to pay interest on their loan, but just 10% of it, because that's what they purchased. And when you put all these numbers together, this looks exactly like this. The dollar return for strategy A is identical to the dollar return for strategy B. Since the dollar returns from A and B are identical, the initial cost of both strategies must be identical. And this is an assumption of efficient markets. We do not expect to see any arbitrage opportunities. There shouldn't be an opportunity. If these have the same dollar return, then the dollar investment should have been the same. We assume that there's market clearing or perfect or efficient markets. So that makes these the same. If these are the same, it forces mathematically, the only thing that's different here oh, there's a typo. Can't believe it. That should be a U here, right? So if these are the same, then VL must be VU. And the conclusion of this exercise is that firm value is not affected by leverage. If we have no taxes and all those assumptions, that is the conclusion. And it is because even if there was no debt, if a person, an investor, wanted to have that amount of debt, they could create it themselves. So from the perspective of the shareholder, there's no difference between these firms. So prospective investors would see these as identical. Okay, so this is a result of with all those assumptions. So this is known as M&M Proposition 1, no taxes. And here is an illustration. I'm going to vary this. Like I said, this is the baseline case. No matter the debt to equity ratio, it doesn't matter. The value of the firm that has no debt is identical to the value of the firm with debt. And this is because of no default risk, no taxes, and investors and firms can borrow and lend at the same rate. All right, so think that over. It might take some time, and it will make more sense in the context of what I'm going to demonstrate now. First, I want to talk about Proposition 2. Proposition 2 looks at the cost of capital. So Proposition 1 focuses on the value of the firm, and Proposition 2 looks at the cost of capital. So what do we know about the cost of capital? If there's debt, we compute the weighted average cost of capital, as we did in class yesterday, as the weighted average of the cost of equity and cost of debt. Notice taxes don't exist, so the extra term is just 1 because this is 0, right? No taxes. So what we see is the return to the average investor in the firm. or the payment or cost, weighted average cost of capital that is paid to that average investor is just equal to the weighted average. So what you have here, we're going to talk about the different returns. We have the return to, this is the cost of capital, or cost of capital for the unlevered firm. Let me do that again. Let me do that again. So RU is the cost of, it's going to be cost of equity because it's an unlevered firm. There's no debt. And then then WACC is the cost of capital in the levered firm. And RS is the cost of equity for the shareholder in a firm with debt. So there's a bunch of different people here. And then RB is the cost of debt in the levered firm. And these are for, I'm going to write it, how am I going to write it? I'll do it in black and then I will outline in red. So these are shareholders and they're in the unlevered. These, the return, the cost of capital here is for the average investor in the firm with equity and debt. And then this is for a shareholder in a firm with equity and debt. And then this is for the bondholder in a firm with equity and debt. So there's a few different characters here. And what I'm going to do, let me clean this up. I just thought of, I can clean this with, these are all for the levered firm, so I'll put them all together, clean this up. So you see, all you have in the unlevered firm are shareholders, but in the levered firm you have shareholders and bondholders, and you can think of them individually, but then you also have to consider the average investor. That's someone who's partly invested in stocks and partly invested in bonds, and this is their required rate of return. And the proportionality of the investment is the same as that of the firm's relative issue of stocks and bonds. And these are market values. Remember, these are market values here. So, what do I do with this? Well, I know in this first setting with those assumptions that since the values are the same, then the returns are the same for the levered and unlevered investor. So this is true. So this is for levered because I have to weigh two different assets, and this is for the unlevered investor. So these are just shareholders. And it turns out that those are equal, and this is how you calculate WACC. What happens, what's the perspective as the debt increases? Bondholders should be concerned to see the level of debt increasing. In a normal state, they would think, the more and more they borrow, how is the firm going to repay or make interest payments? Now, bondholders have a claim to the firm's profits, right? They have a claim in terms of the contract, that the contractual arrangement through the indenture with the firm. So they expect to get their return, and there's a commitment. So they could actually take the firm to court if the firm doesn't make their interest payments. But we've assumed that that's not going to happen. I assume that there's no default risk. So it shouldn't matter how much debt there is in terms of bondholders here. This will not change the more debt issued. The WACC won't change because I've said that there's no difference between the return for whether there's debt or no debt. So that's not going to change. But what will change is the return to shareholders. Algebraically, you can isolate the return to shareholders here and see the effect of the increase in debt. So let me derive that first, and then we'll interpret. So I'm just going to take, I'm going to erase this first. Erase this, and take this with me. So let's isolate for the return. And let's use, don't worry about using, let's erase this. We don't need this part. We'll just use this. Okay. So this would become and then And then what I want to do is solve for RS. So I'm going to move this term over there. And then finally, RS is equal to RU plus RU minus RB times B over S. And this is what I wanted to find. What does this say? That shareholders require a higher level of return than as though there was no debt, where the return to debt risk is smaller than the just all equity firms cost of equity. So the return to, or the cost of debt is always smaller than the cost of equity in a firm with no debt. So shareholders will demand increasingly higher return the more debt is issued. This will always be positive. So remember, debt is less risky than stock or equity because there's a guarantee, there's some sort of guarantee. And there's recourse that if bondholders are not paid their interest payments, they have a legal claim. They can actually take the firm to court. So there's less risk in being a bondholder than being a stockholder. And the appropriate risk-adjusted rate of return for shareholders in a levered firm would be more than if there was no debt, and it would be equivalent, and it would be based on the debt to equity ratio. The closer these are together, the closer these are together, the less now this won't be so high, right? So this is increasing as a function of the debt to equity ratio, so more debt than equity. And it's also an increasing function based on these being very different. The cost of debt and the cost of equity in the unlevered firm. So cost of equity has two parts. RU, which is the risk inherent in the firm's operations, which can be derived from the beta of assets in the unlevered firm. And then there is also the debt to equity ratio and the financial risk. That's the extra risk from issuing debt. the more debt holders there are, the less stockholders can claim, right? So they will demand a higher rate of return to adjust for that or compensate for that risk. All right, so we have Proposition 2 illustrated here. What do you see? So here you see no matter how much debt, the return to bondholders does not increase. There's no default risk. They're not concerned that there's more increasing debt, and any risk that they will not get paid is removed. So we've already assumed that away. We've also we've also found, given our assumptions, that the WACC is equal to the return to shareholders in the unlevered firm. So let me be clear. This is the return to the levered, and that's the return to the unlevered. And then I've plotted, it's just a line where the slope is this term. The debt to equity ratio is on this axis, so this is the slope. And the return to equity is adjusted. It increases, it's an increasing function of the debt, because the more debt is issued, the less likely shareholders will have a claim or be able to, as residual claimants, they probably won't get dividends, okay? So they demand a higher rate of return the more debt is issued. So this is the cost of equity, the cost of debt, the weighted average cost of capital. This is all M&M Proposition 2 without taxes. And now I move to introduce taxes. Any questions so far? So all we've done is I introduced a model known as M&M, the Modigliani-Miller model. I made a number of assumptions to support the base case where debt issue doesn't change things. In terms of the value of the firm. The value of the firm does not change just because the firm borrowed money and brought on creditors. The value didn't change, and we sort of discussed that that's so unrealistic and why it's unrealistic. So now what we're going to do is bring in some reality. We're going to extract away from the assumptions and make this a little more realistic, or at least we're going to determine the impact of those assumptions, okay? So let's peel away by beginning with introducing taxes. So we're going to allow taxes. So taxes now create an incentive or a rationale to issue debt. There's a benefit to issuing debt from the firm's perspective because there's a interest tax shield as a result of being able to expense the interest payments made to bondholders. We continue to assume that the cash flows are perpetual. And we have to introduce these because otherwise it becomes more complicated, right? Remember in capital budgeting, when we introduce taxes, there's tax treatment of capital spending or fixed assets. So there's no capital budgeting considerations here. All we've done with the other assumptions, we've added in taxes. We still have perpetual cash flows. There's no fixed asset. There's no net working capital spending of this change. There's nothing, no depreciation. There's nothing to consider in addition. We're just going to issue debt. So debt goes from $0 to $400. How does this look? When the firm was unlevered, let's use this as their earnings. So we used the example before. Y is how much they earned, but I'm going to say it's $200. Okay, so $200 are the earnings before income, interest and taxes. The interest payment for the unlevered, well, there's no interest, so this is just 0. For the levered firm, it would be 40 because it's 10% rate for $400. So that is, interest payments are going to be so they borrowed $400 and they have to pay $40 in interest payment, but this is a tax deductible expense. So I'm going to put it on in my chart. And now because it's tax deductible, the net income or earnings before taxes are $160. So when you calculate the amount of taxes, it's based on 160. This is 160 times the tax rate of 40%. Which is 64. So then 200 minus 64 would be the net income. Everyone okay so far? So we have, just to review, these are the earnings. We made them the same. And then interest for the levered firm is 10% of the $400, so that's $40. And that left $160 to be taxed. So 40% of that makes a $74 amount of taxes, and then you remove that from the 200. Oh, and that's also minus 40, right? 200 minus 40 minus 64. That equals 96. So you have here the net income, but remember, we're dealing with cash flows from assets. So cash flows from assets would be the earnings less the taxes, basically creating a difference of the tax shield. So if I exclude the interest payments and I just look at the cash flow from assets, the tax deductibility of interest payments creates tax savings worth $16 over and above the unlevered firm, over and above their cash flows from assets. So it looks like something's happened here. The levered firm appears to have increased its cash flows. Now these cash flows should be perpetual. We discussed perpetual cash flow. So these are the future earnings potential of the firm, which we would have to use time value of money to calculate the value of the firm. But we also, so what we're going to do is work with the unlevered firm amount and add the tax savings that could have been computed using this chart. All right, so this is just 1 year. In 1 year, it's $16 tax savings. But since this is perpetual, this happens forever, I would have to use the formula for valuing perpetual cash flows. That's what it would be. That would be the perpetuity formula. So doing that, I get 160. So where did I get that from? I found the interest effect of tax savings from interest at 16. How did I do that? That is equivalent to TCRB. So that's just the tax rate on what was deducted from taxable earnings. This is the 16. Sorry, that's not true. This whole thing. So this RB times B is this amount here. Interest. Right? This is RB times B. So those are the interest payments. And then notice this is RB times B and this is TC. So this is the formula for tax savings. And that's where this comes from. And this needs to be valued perpetually. So these end up canceling. And you get TCB. So how does this affect the value of the firm? In going from unlevered to levered, and numerically in this example, it's $16 difference. The $16 is essentially this amount. This is in 1 year, so I need to use a perpetuity formula to compute it as the present value of future cash flows in perpetuity. And that gives me the expression TCB. So the value of the levered firm is now seen as an improvement on the unlevered firm. By adding debt, you can increase the value of the firm. So given the assumptions, including that of no default risk, it is apparent that debt can be issued and directly influence the value of the firm. The value of the firm is what shareholders care about. So paradoxically, surprisingly, shareholders want bonds. They want debt. They want unlimited debt because that will make the value of the firm unlimited. So here's the same diagram, but now I've introduced the value of the levered firm with taxes. And this is just a straight line. The higher the debt, the higher the value of the firm. It's a linear relationship. So this was the baseline case that there's no difference. But now you add taxes. And the interest that can be tax deductible, creating interest tax shields, adding this term in perpetuity, more debt, unlimited debt creates unlimited value. So this is problematic because it's very unrealistic. In fact, at some point, bondholders would be concerned, all right? But we've eliminated default risk. So let's continue with the implications of this model, and then we'll reintroduce default risk. Okay, question. Okay, back to the example for Kari. So here's the effect, here's the tax shelter. It's tax savings because the interest is tax deductible. So rather than paying taxes on 200, you pay taxes on 160. 200 minus 40. So then 160 times the tax rate is just 64, which is better than 80. And in trying to value the firm, we care about cash flow from assets, right? We care about present value of future cash flows. So what we really care about is the difference between earnings after taxes which represents an increased because of why? Because there's a difference here of 16. But I'm trying to find an equation to demonstrate that. So basically, because RB times B is tax deductible, it creates tax savings. It's just like the tax shields. When we multiply TC times D for depreciation, you should think of that. Now this is TC times RB times B. I can mark this up again if that helps. Let's see. So there's no interest payments here because there's no bonds. Here there's $40 worth of interest payments because there was $400 issued at 10%. So that makes interest payments of $40. So now taxes are computed on $160 because 200 minus 40, the tax deductible interest payments is 160. So 160 times 40% is 64. And your net income is 96. But what I'm interested in is cash flows from assets. So from assets, we see earnings, right? And then we also get tax savings because of the tax deductibility of the interest payments. How much are tax savings? Tax savings are $16. So that's one way you could calculate it, but you want a more general formula. So the general formula is here below. It's going to be TC times the amount of interest deducted from taxable income. Just like when we did it for TCD, we used depreciation to reduce the taxable income, and it created a tax shield each year of TCD. So now we're doing TC times RBB. So it's just like the same mathematical logic. Now, where was I? All right, so let's look at an example before we look at the effects on the cost of capital. So here's an example. And I'll leave you with this. See if you can make sense and frame some questions for me. I'll give you, let's take 5 minutes. I'm going to turn my microphone off. Okay, I'm back. Questions? Have you got any questions? All right, let's see. Okay, so taxes and firm value, an example. We have earnings. Remember, earnings are perpetual. So we want to figure out with taxes at 30%, and this is the cost of capital or cost of equity in the unlevered firm. This firm then goes from having no debt to $100 of debt at a rate of 10%. What happens to the value of equity? Well, let's first get the value of the firm. So the value of the firm is the present value of future cash flows, right? So future earnings or future cash flows to the firm, cash flow from assets. And those will be earnings before interest and taxes after tax. So that's the perpetual amount. This is the after-tax perpetual amount, and this is the valuation using the perpetuity formula. Okay, so for the unlevered firm, no debt, this is what you get. So let's calculate that. That will be 100 times 1 minus 0.3 or 0.7, and then divided by 0.125. Okay, I'm trying to make it clearly 0.13 or 0.3. Okay, so then this is 100 times 0.7 is $70 over 0.125. Okay, and what do you find? Very good, 560. Good. Okay, now what's the value of the levered firm? How will you figure that out? Very good. Samuel, Anouk, Harry, Francette, very good. Okay, now go for the value of the levered firm. Very good. Yes, 560. Now what about this amount? So what should you do for the levered firm? Well, we learned that there's a relationship, right? We have a formula above. Let's use it. Let's take this with us down. So right, we have this relationship here. So that means that the levered firm is worth the unlevered firm plus the perpetual tax savings from interest deductibility and the tax savings that accrue from that. So this will be 560 plus 30% of B, and B was 100. So you get how much? Very good, Anouk. Very good. Close, Caddy. It's 590 because this amount is 30. So by issuing debt, what is the effect in this setting? What is the effect on shareholder equity? What happens to the value of stock outstanding? So the firm has taken on $100 worth of debt and gone to $590 in value. So what is the value of shareholder equity? It would be 590 minus 560. Sorry, not minus 560, but minus 100, or 490. So shareholder equity went from 560, this is what it was before, right? Because this was an all equity firm. So it used to be 560 It used to be 560, and by taking on debt of 100, it becomes 490. So it looks like I don't know why I keep writing that $sign here. So it looks like shareholder equity value has gone down, but the value of the firm has gone up. So based on our first discussion about shareholders caring about the value of the firm, they're happy the value has gone up because they imagine they'll realize greater profits or gain or payout. So here is the value of the shareholder equity. This is just the value of stock, right? And it went down. But the value of the firm went up. So now, what's next? Let's see. Let's continue with this example, but I got to take a break to talk about the impact on the cost of equity, okay? I'll leave it here for a moment in case people are copying. Let me know if you have any questions. So let's look at the WACC. We have still debt, taxes, and now Proposition 2. Let's look at the WACC. Remembering our relationship for the levered firm, now we have taxes, so this term is reintroduced. And if you were to conduct the algebra, you would find this is the expression, okay? So this is the adjustment here. And it shows you that the required rate of return of shareholders in the levered firm is adjusted. It's over and above what it was initially for the additional risk taken on by having bondholders who would be paid first and squeezing out possible payments to stockholders. We still assume there's no default risk, and this is our result. So let's calculate the return to equity for the levered firm using this expression. And then we can I need to show you how I got this, don't I? Well, let's just say this is the Proposition 2 adding in taxes. This is the adjustment. This is the only difference between the formula without taxes and this one. So what we're going to do is calculate this and then use it in here to solve for the WACC. So compute this first. And let me grab what I wrote about the different actors, the different players. Let's see where I put it. It's not here. Should I put it here? No. Here. Okay, so remember these characters. Okay, so we have the shareholders in the unlevered firm, and then we have these characters in the levered firm. So this is the unlevered firm, shareholder required rate of return. And to be incentivized to invest in a levered firm, a shareholder would require an adjustment relative to the debt to equity ratio. The more debt relative to equity, the higher the rate of return required, because it's less likely shareholders will get a payout. That's just because bondholders will have first claim on any profits. Okay. All right, so let's put this together. So from the example, RU is 12.5. RB is 10. B is 100. And S for the levered firm is 490. And then 1 minus TC is 1 minus 0.3. So what do you find? This number should be bigger than 12.5%. RU was here, look. It's in the problem. So that's the shareholders' required rate of return for the firm that has no debt, just all equity firm. Front set got us an answer. So I get 12857. Excellent. Un autre français. Wonderful. Morlan, did you understand my answer? So now let's get the whack. So we're going to store this. We can store that value. And then I'm going to expand this so I can write smaller. So the whack will be it's going to be RS, which is 0.12857 times S over B plus S, right? So S for this is for the levered firm. We got 490. And overall, it was 590. So that would be that. And then for RB, it's 10% for RB times 100 over 590, the new value, and then 1 minus 0.3. That would be the whack. So that's S plus B, S RS, B over S plus B, 1 minus TCRB. Okay, so I didn't write it exactly like this, but it's the same components. And I should put 5.7. It wasn't 7. 0.128571429. Very good. 11, like almost 12%. So we have these two results. We use this one in the WAC. And notice we went from the cost of capital RU, which was 12.5%, to now we have WAC that is different. Now this is not the case in the first, without taxes, right? WAC and RU were the same, but now they're different. It's 12.5% and WAC is like 11 point, did I write it wrong? 0.11, I wrote it wrong here. It's 11, not, it's 11. Not 0.01. So it's 11.864. Wait a second. I did something wrong here. 11.864. Let me double check. How could I get that wrong though? Okay, let's try this again. Yeah, we got the same. So it went down. And it went down because now that you have included bondholders, the average investor in the firm is part bondholder and part stockholder. And the bondholders have a low level of required rate of return relative to that required for equity. So the average ends up being lower. Can anyone else reproduce the number? Oops. Sorry. All right, so what was I saying? All I said was I read, let me put that down. Dear. Let's fix this. Hold on. Okay, let's go back to what I was saying below. Or above. Okay, so all I said here, I lost everything. Oh my goodness. Okay. So what I was saying here was that notice that the WACC decreases as more debt financing is used. Okay, that's the formula. That this will decrease the more debt financing is used because although RS is going up, this term begins to dominate. Okay, and this ratio becomes much smaller. So what happens is the average investor whose cost of capital is WACC, the average investor increasingly begins to look like a bondholder. So it is the bondholder who will be financing the firm. So since WACC is discount rate for future cash flows, the optimal capital structure is an all debt structure. So all you're going to have in the end are bondholders. In the end, or I mean, the higher and higher the debt, you're going to have just squeezed out or converted shareholders into bondholders, possibly. But the point is that the WACC is decreasing, and it's decreasing to be what? Well, since the average investor is a bondholder, WACC is decreasing to be the return on debt that bondholders get. Okay, so with more debt relative to equity, this WACC will just represent the return to bondholders because pretty much it'll be bondholders holding a stake in the firm. This is a flat line because bondholders have no default risk, so the more and more debt issue, they're not concerned that they're not going to get their interest payment. So there's no default risk. That makes this flat. The return to investors in the unlevered firm, these are just the shareholders in the firm without debt. So this is irrelevant. This is just flat. These are the investors who are shareholders in the levered firm, and they require a higher rate of return because they are concerned the more debt issue, the less likely that they are to be paid dividend. So they require a higher rate of return. So this is the map. I can't seem to paste it without gluing them together. So this is the that's the shareholder in the levered firm. This is a shareholder in the unlevered firm. So there's no effect here of debt because there is no debt. And the most important thing is that the average investor becomes a bondholder. And this is all because of taxes, along with the other assumptions. So finally, so we covered case 1 with all the assumptions to make the value unchanged if debt is issued, no matter how much debt. Case 2, where we introduce taxes, but leave most of the other assumptions in place. And finally, we're on case 3. Case 3 is where there is a risk of default. And that could lead, if default appears imminent, then there's a risk of financial distress and all the costs that come along with it. Does anybody have any questions? So this is case 3. So we have case 1, case 2, and now case 3. Financial distress and the result. So I'm going to finish this and then we're going to go for a break. And when we get back, we're going to look at some exercises together. Okay? And then really tomorrow we can just review, we can look at exercises or problems you have, because I will have finished teaching the material today. All right? All right, so remember the result of Modigliani-Miller with taxes, where debt provides tax benefit to the firm. It implies that the firm should borrow an infinite amount. But in reality, the firm has to pay interest and principal to bondholders. If the firm defaults on a payment to its bondholders, it will enter a phase of financial distress, or ultimately, if financial distress persists, the firm will declare bankruptcy. There are costs involved in both financial distress and bankruptcy. So we need to consider an augmented model. I'm going to go back to that slide in a minute. This is our augmented model. The value of the firm should be adjusted to these realities, where the levered firm is equal to the value of the unlevered firm plus the perpetual tax savings as a result of interest payments, but minus, at some point, the level of debt will signal a risk of financial distress or default, and then a risk of financial distress as a consequence. So at some point, this part of the function kicks in. For firms with a low financial leverage, the probability of default is close to 0, and so this estimated present value of expected costs of financial distress is just about 0. So that a $1 increase in debt will increase tax benefits and the firm value at a constant rate of TC. However, for highly levered firms, the probability of default is positive, and this could be a function, it could be an amount, would be positive. In this case, a $1 increase in debt will increase tax benefit at a cost of rate TC, so that's good. But it also increases costs of financial distress at increasing rates. The conclusion is you want to increase debt as long as tax benefits exceed the present value of the cost of financial distress. So what we're trying to say is we would ideally find the optimal level of debt, balancing off the benefits with the costs. So, what are some costs? I'm going back to page 16. What are some costs? So, as explained, bondholders have a legal claim as a contractual commitment in their bond indenture. They have been promised either the face value of the bond, right? The matured value of the bond, so they get their principal back, and also they are possibly with coupons or with interest payments. Through coupons, they are promised those. So whatever the case, bondholders they lend money to the firm with a promise and a commitment that should be honored. And if it's not, they have a legal claim on those unpaid amounts. So they could take the firm to court, and they could force the firm into legal battle, and this could be very expensive. It will be the trial costs and any kind paying experts, witnesses, accountants, and lawyers to make the case and to work with the representatives of bondholders to come up with an agreement of how whether the bondholders should get just a fraction. They want to be compensated for their claim. And bondholders can be individuals, they could be other firms, they could be in pension funds, they could be very sophisticated or very unsophisticated, but together they hire legal counsel and they fight for their lost revenue, their lost income as a result of the firm defaulting on their payments. So that's the direct cost of financial distress, going to court and dealing with all the administrative costs of that. But then there are the indirect costs. The media might get wind of what's going on, and then this will be released to the public, and the public, being aware of this, may be less likely to do business with the firm. So we have cases of, like, for example, Sears is a department store. I know it's in the United States and in Canada and Puerto Rico, and it has been closing down department stores for the last 10 years. And now think about appliances. Sears sells appliances. Sears sells appliances, and as a potential customer, do I want to buy appliances from a company that's under receivership, like is in court or is in a state of bankruptcy? If I buy an appliance with a warranty, am I sure that warranty will be honored? So there'll be people questioning whether they want to buy appliances that have any kind of warranty service, because they might not even get that service. In addition, maybe suppliers don't want to do business with Sears, because if they supply, or vendors that sell them, or distributors that sell them products, maybe they think, well, are they even going to pay me if I deliver? So they'll lose those kinds of relationships. So this is an impairment to the ability to conduct business with the firm. There's also agency costs. Agency costs are as a result of management individuals in management divorcing themselves from the responsibility of stockholders and just operating in a selfish way to benefit themselves as they see that business is not doing well. So they might be incentivized to just not operate on behalf of the stockholders as the ship is sinking. There may be stockholders might lose representation. Maybe managers might be looking for other jobs and not otherwise devoted to doing business or to doing their jobs in the firm. So this is a breakdown of the agency relationship between stockholders and the managers and has associated costs. Also, in financial distress, stockholders themselves may engage in selfish strategies. They may be seeing that bondholders are eating up profits through, well, not just that. The company might be forced to liquidate some assets and have them distributed to bondholders. Well, what should stockholders do? Stockholders seeing, that this is a potentiality or this is happening, they might have incentive to take larger risks so that they can tie up the firm's capital and keep it from being acquired. So they might have an incentive to take large risks, or they might have incentives for underinvestment, not taking positive NPV projects. So they're going to operate inefficiently, essentially. So maybe instead they will issue themselves, they will liquidate assets and then distribute them as dividends to themselves or encourage management to do so. All right? And also pay off managers for doing their dirty work. So these are all costly. They contribute to inefficiencies, and these are all economic indirect costs of financial distress. So, what we imagine is that this linear relationship, this line where it looks like unfettered, untethered debt is ideal. Once you put in the risks of default, this augments that relationship. And you see here, the benefits of debt up until a point begin to plateau and then drop off. So there's a negative impact of too much debt. So this is the new valuation. This is the value of the firm. This is the firm with no debt. This is the firm with no taxes, with taxes but no default risk. Once you put in default risk, make this more realistic, you have to consider what would be the optimal level of debt before the costs outweigh the benefits. And finally, and we'll pick up here and I'll review this when we come back, we'll look at the Proposition 2, or the effect on the cost of capital. So we'll look up here, we'll look here, we'll look at this when we get back. So let's see you back here, take an hour break, see you back. At 5 p.m. Okay, I will send another invitation. And that's it. That's the last page of the notes. So all we have to do is practice exercises for this evening and tomorrow. Okay, so enjoy your break. We will pick up here at 5 o'clock. Let me know if you have any questions. Thank you, Francette. Okay, if you don't have questions, I'm going to sign off. Bye.